Welcome everyone to this Tuesday edition of Inside India. I'm Sri Jegarajah. Let's get across your headlines. US Commerce Secretary expects there to be a trade deal with India soon as US officials head to Delhi for talks in the coming days. India says Tesla is not looking to manufacture vehicles in the country, even as India rolls out its EV policy to attract global automakers. And Yes Bank shares will be front and centre today as its board meets to consider a fund-raising proposal. Welcome to the programme. Let's get a state of play in the Asian markets. Broadly, they are looking positive. And at this point in time, the Hang Seng Index is the runaway leader, up by 1.5%. This is despite the fact that we got private sector Caixin manufacturing PMI showing the sharpest fall in orders since September 2022. However, the market seemed to be relatively unfazed by that. So let's take a look at commodities. And the complex broadly, oil prices were up 3% in the US session on the back of the OPEC Plus decision over the weekend. Gold holding near 3-week highs. The Indian markets join us in about 45 minutes' time. Let's give you a sense of what to expect and bring in Gift Nifty futures, and they are indicating 24,845.50 at the open. 25k, recapturing of that 25k mark, has been a tough nut to crack. So if we do open at this level at around 24,850, that would represent upside of about 100 points. So the benchmark does seem to be stuck in something of a band at the moment. Dollar rupee at 85.4480. Now, US Commerce Secretary Howard Lutnick says he expects to strike a deal with India in the not-too-distant future. Speaking at the US-India Strategic Partnership Forum's Leadership Summit in Washington, Lutnick said the US could get better terms from being, Lutnick said India could get better terms from being early in line. It comes as a US delegation heads to India on Thursday for further trade talks. India, meanwhile, says Tesla is not interested in manufacturing its cars locally in the country. This even as the country outlined its EV policy that would slash import taxes to 15% from 70%, but only if foreign car makers invest $500 million to build their products in the country.
Tesla, we are not actually expected from them. They have only to start two showrooms. They are not interested in manufacturing in India.
India's Minister of Heavy Industries speaking there, he said Tesla is currently focused on importing their vehicles into the country, though he said other foreign automakers, including Mercedes, Volkswagen and Hyundai, had expressed interest in its EV manufacturing policy. Elon Musk has criticised India's high tariffs, but it's unclear if the US EV maker will change its current plans. There's been no comment from Tesla. And it was a pretty muted debut for Schloss Bangalore in Mumbai yesterday. This is the owner of Leela Hotels, a luxury hotel chain owned by Brookfield Asset Management. Issue price was 435 rupees a share. The closing price, flat, 435 rupees and some change. Indian markets off to a tepid start in June following a rather muted gains for May. The stock market has been on a decent run in the last 3 months, with the Nifty up about 12% in the 3 months to May, outperforming the benchmark MSCI Emerging Markets Index. Stronger than expected corporate earnings, cooling in the tariff war and continued retail optimism have been driving those gains, while foreign institutional investors were net buyers for a second month in May. A recent Reuters poll suggests the Nifty could still hit fresh highs by the end of the year, but valuations which are sitting north of 20 and far higher than its EM peers could mean a correction in the coming months. Let's just stress test those views with Gautam Dugat, our next guest, who is the head of research in institutional equities at Motilal Oswal of Financial Services. Gautam, what do you think? Is a correction coming, given the state of valuations in the Indian market?
Good morning. Thanks for having me here. So we've already had a correction from September to March. we'd corrected close to 12-13% on Nifty 50 and about 18 to 20% on mid and small cap indices. What has happened in the last 2-3 months are several tailwinds have emerged. The most important being the corporate earnings season, which just concluded 2 days back, has been far better than expectation, both in terms of the aggregate performance as well as the spread of the earnings and the sectors which have outperformed versus expectations on earnings front. So that has provided a lot of sort of comfort to investors because the first 3 quarters of the year were flattish, and we've exited FY25, the last quarter, fourth quarter, with a good momentum in corporate earnings now. Second, the valuations have corrected because there has been a time correction plus price correction between September 2024, which is when we hit the highs, to May 2025. So almost 7-8 months of time corrections happened and earnings have got rolled forwarded. And not that we are cheap by any standard, we are still trading at 21.5 times. The long period average for Nifty is 20x. So instead of any big price correction, I would expect a very range bound movement till earnings catch up with the underlying valuations. And then, of course, from there, we'll take it sector by sector. Suffice to say that the broader markets, mid and small caps, are still very expensive compared to large caps.
And we will get into that at a sector level, Gautam, later on in the conversation. But do you feel that on balance there are enough aggregate positive catalysts in this market when you look at the macro, when you look at 7.4% that we saw last week, Q4 GDP, to get the benchmark Nifty back above 26,000? Is that where we roughly close out this year? And what then is your end of year target for the benchmark?
Sure. So absolutely, Indian macros are the best that they've ever been in the last 2-3 decades. Be it GDP growth, inflation is well under control. 3 months in a row, the inflation print has been below 4%. Our forex reserves have climbed up back to close to $700 billion. The currency has recouped the losses that it suffered in Jan and February. Plus the monthly data point, the GST data which came yesterday, it's up 16% YOY, which is basically the best month in 18 months, right? So macro data points are perfect. Corporate earnings has also rebounded, as we just discussed. And globally, the headwinds which were there on geopolitics, there seems to be abating a little bit. So I wouldn't be surprised if we venture near the vicinity of 26,000 on Nifty towards the end of the year, because we'll still be going there with a gap of 15 months. So that would have allowed the valuations to cool off and at the same time earnings to adjust to those valuations. So I wouldn't be surprised if closer to December 2025, we inch up towards 26,000, because while that number looks psychologically big because it's all-time, but from here it is just a 4 to 5% kind of an upside. What I would, however, be more keen to observe is the breadth of the market, because the breadth of the market had suffered a little bit. The smaller caps, the mid caps, they've undergone decent correction, and for right reasons, because the valuations had become exorbitantly expensive back in September, October. Now, earnings have been very good for mid caps, right? Amongst the large, mid and small cap, mid caps have delivered the best earnings. So it will be interesting to see how the valuation interplay with earnings happen over the subsequent 9 to 10 months. So that is more important for me rather than a static Nifty target.
Understood. Gautam, what could go wrong with this current setup, which is looking admittedly quite constructive? We still haven't seen the crowding in of private sector investment. There's the possibility of a flare-up in the Indo-Pak conflict, a global bond market sell-off, a collapse in the US-China trade detente. We're already starting to see those cracks. What could go wrong with this broadly positive consensus for the Indian market?
So as far as risks are concerned, we think the biggest risk will emerge from globe, pertaining to either a trade policy or a global geopolitical headwinds, not just limited to India, but other countries too. As far as India is concerned, we think we are in a quite a balanced space now. We have a RBI policy coming up. We're expecting another 25 basis point of a rate cut. So risk largely, which can damage the market durably and to a slightly higher magnitude, will stay mostly from global factors. We don't expect the domestic factors to cause much of a heartburn, because do remember that the flows have been exceedingly strong. Last year, Indian domestic investors invested $63 billion in calendar 24. This year so far, first 5 months, we've already seen $33 billion from the domestic investors. And this is despite continued selling from foreigners. We've seen about $11 billion of selling from FIIs. So despite relentless selling from foreigners for the last 3 years now, cumulatively, if you add up the domestic flows, they are totaling to about $110 billion, which is a massive number, coupled with the monthly SIP book itself of $3 billion now. So flows will temper the downside and also withstand the volatility which is inherent in this kind of a market. But to answer your specific question, the risk largely stems from global factors.
Understood. Let's bring in selectively IT services, Gautam, pharma, car makers like Tata Motors, namely those with exposure, the most exposure to the export markets. What did earnings and guidance especially tell us about how those parts of the market are holding up?
So amongst the three sectors that you mentioned, pharmaceuticals look the safest right now because both the domestic formulation segment as well as the US market, the two very important contributions to total revenue and profit pool of pharmaceutical sectors, they're looking quite okay. In fact, this quarter also, pharma delivered a good double-digit earnings. This is now the 8th consecutive quarter of 14-15% kind of an earnings growth for pharma sector. So that looks quite okay to us. And within pharma, obviously, hospitals are outperforming the traditional generic names. The concern largely stems around the US IT spending, because that is where the biggest challenges persist around this whole trade policy and flip-flops in the US. So what we were expecting 6-9 months back, that discretionary spending in IT, which is technology in US, will revive somewhere towards the second half of FY25. We've changed that stance 3 months back. So we are now expecting the discretionary IT spending to revive only in second half of FY26. So therefore, the tech stocks could remain slightly more range-bound. And our usual thesis has been that in any year, if you look at India, the banks and IT stocks do not outperform together ever. The only exception has been the year CY17 in last 20 years. This year, so far, already in the first 5 months, the banks index is up 10% and IT index is down 14%. So we don't expect IT to start outperforming banks. Our preference remains more towards bank, consumer discretionary, industrials, and IT we like because of valuations.
Understood. Gautam, and just on the banks, Goldman Sachs upgraded the sector last month. How convicted are you towards the banks and financials? And can you name names? Who is emerging as best of breed? Because I've been hearing that the consensus top pick is ICICI. Is that the best way to express
ICICI Bank is also
an overweight position in the banks and the financials?
Sure. So we do like financials. We have an overweight stance on entire BFSI sector. In private banks, we of course like ICICI Bank. It's a consensus top idea for both buy side and sell side. But aside of ICICI Bank, we also like Kotak Mahindra Bank. However, the real alpha, in our view, in financials will come from non-banks, which is the NBFCs and at the same time the non-lending NBFCs, basically the capital market stocks. We have a very positive view on capital market names like Angel, Bombay Stock Exchange, HDFC AMC, Nuvama, and within the lending NBFCs, we continue to prefer, Sri Ram Finance. We also like Chola Finance and Bajaj Finance. So we think, given the rate environment that we are in, and we are expecting another rate cut in this monetary policy, as we move forward 6 to 9 months, the cost of funds will become a bit more benign for the lending NBFCs. So while we like banks, we think the alpha will be generated from non-banks within the financial space.
Gautam, I hope you don't mind me putting you on the spot a bit, but NSE, if and when it does come to market, and we all know how it's mired in something of a running battle and a challenge with SEBI over what it needs to do to change before it gets to an IPO. But if and when it does, would you be a buyer of NSE?
Absolutely. But do remember that NSE is, I don't know the exact valuations prevailing in the private markets, but the stock has done really well in the unlisted space in the last 6 odd months. However, I do expect that whenever it comes for listing, there will be a massive demand for that stock. It's a virtual monopoly. And given the kind of inherent shifts that we are witnessing in the domestic savings pool and the preponderance of the savers to move towards equity, I think NSE will become a a stock which virtually becomes an allocation stock for everyone in their respective portfolios.
Thank you for addressing that, Gautam. How are you approaching broadly these new public listings? Because Schloss Bangalore underwhelmed yesterday. Many new entrants are frankly not profitable or don't seem on a path to sustain profitability. Is that a reflection of the misalignment that we have been seeing between private and public market valuations?
See, look, IPO's performance is always a function of the market sentiments. Right now, the market sentiments, while they've improved from February, March, they're still not where they were 8-9 months back in September and October. So definitely IPOs, some of the IPOs may see a very tepid or a lukewarm listing. Second, in many spaces, wherever the listings are happening, there are already well-established incumbents which are present there. So a lot of investors might think of, increasing their allocation in their existing stocks in the portfolio in the same sectors. Second, as you rightly pointed out, valuations, there is always going to be a little bit of a mismatch between primary and secondary market, and that is what we are also seeing at play. But I think as we move forward, as the sentiments improve further and corporate earnings pick up, you might see IPO markets reviving faster than what we are imagining right now, because they've always been very volatile. So, but yeah, of course, from an investor's point of view, one has to be very, very selective on both valuations and underlying corporate fundamentals of the listings which are happening.
Gautam, but are the longer-term drivers of stocks like Ola Electric and the two-wheeler EV segment, or Swiggy and e-commerce, and we've seen that area rapidly undergo change with premiumization, quick commerce, does that mean turnaround is on the horizon and sustained profitability is on the horizon and that will come? Or is the business model and management fundamentally flawed?
So we are very positive on quick commerce. So the names that you mentioned, Zomato, Swiggy, and even the unlisted ones like Zepto, as a house, we've been extremely positive on this sector for the last 2-3 years. What is going to change there is the visibility of a long-term growth is very, very benign there. The sector itself at a top line level is growing at 20%. And within that, some of the companies which are executing well will have the opportunity to compound upwards of 25 to 30%. And with that comes the operating leverage and scale. And we do expect both Swiggy and Zomato to have a decent profitability in the next 2 to 3 years. What has changed the game? I mean, it had begun with food delivery. And in the last 12 months, we are talking mostly about quick commerce. Food delivery has become a relatively more stable 17-20% kind of a growth segment. However, quick commerce is growing at 5 to 6% month on month, which essentially means on an annual basis, they're growing at 50-60%. Very difficult to find such kind of a growth in traditional old school consumer stocks, which are growing at 4-5% max. So definitely we do expect major wealth creation to still happen in this space. As regards EV, I think it's going to be a bit of a tricky proposition because EV penetration is still very, very low single digits in India. It'll take a lot of time and a lot of money and cash burn will happen there. Second, the competition will also evolve. So EV, it is not as clear to me right now. However, on the quick commerce side, we are very clear that this is a space which over the next 3 to 5 years is going to create tremendous wealth.
Gautam, thank you for that. Final question is on Yes Bank. The board is meeting today to consider further fundraising. Do you like the story there, especially under partial SMBC ownership, possibly majority ownership in time?
Unfortunately, we don't have a coverage on Yes Bank yet, so I won't be able to comment there. However, within the banking space, our preference on the large cap is ICICI, Kotak and HDFC. And on the mid cap side, we like AU Finance and Federal Bank. Yes Bank, we'll have to see how things evolve, when the fundraise happen, who's investing, at what terms and conditions, and how the underlying fundamentals behave. But right now, we don't have a coverage, so no definitive view there.
Understood, Gautam, thank you. And Yes Bank is in transition. It is a turnaround story. Let's see what this partial SMBC ownership can transpire and turn up. Gautam, we're going to leave it there, sir. Great insights. Thank you very much indeed for joining me on Inside India.
My pleasure.
Gautam Dugard there of Motilal Oswal Financial Services. Now, South Korean markets are closed today as the country heads to the polls for a snap presidential election. We'll be live in Seoul with CNBC Sherry Kang after the break. Welcome back. South Korea's presidential election comes at a critical time after 6 months of political turmoil. Sherry Kang is live in Seoul. Polls closed, Sherry, 8 p.m. local time. Do we have any idea what way the wind is blowing?
Yeah, so I think it's safe, or it's a safe bet at the moment. The Democratic Party's Lee Jae-myung is a front runner. That has been really what the polls have been suggesting. That's what the market is going with as well. But at the same time, we need to bear in mind that the Conservative Party, People Power Party's candidate Kim Moon-soo has been really narrowing his gap with Lee Jae-myung. So that is something that we need to be watching out for. Just to give you some color on what this election really means. It's a reset button. And of course, we're talking about an election that is happening after 6 months of a political uncertainty. And that's the reason why. And of course, this has to do with the martial law declaration from the predecessor. So I think for Lee Jae-myung, who is a front runner, by the way, he is largely describing the martial law declaration by the former president as an act of insurrection, and voting for him would mean writing a new chapter in South Korea's history. So that is his platform. Now, his pivot to some of the centrist ideas have been quite fascinating, not just the economic policy, financial market-related policy pledges, but also on foreign policy. But here is Ian Bremmer. He is the president and founder of Eurasia Group, speaking to CNBC earlier this morning. And his idea is basically don't trust the pivot just yet. Take a listen.
He has campaigned as a centrist. He's campaigned as someone that's going to bring everybody together. But that's not his history at all. For many decades, this has been someone who's very critical of a South Korea-Japan rapprochement. He's been much more soft on engaging with China, where Trump absolutely is not right now. He's been much more problematic in terms of fiscal restraint at home, all things that are going to be much harder to govern on if he turns to revert to traditional style, as I expect he will. I don't think he suddenly changed the spots just over an election and decides to govern much more to the left once he wins.
It's important for me to point out how both major campaigns have been running on this idea that, yes, the South Korea-U.S. alliance is the backbone of South Korea's foreign policy. And given the security importance that U.S. has, that makes sense. However, remember, the Trump administration has been increasingly reluctant in this security alliance, calling for more financial contributions for the U.S. defense costs and so on. So I think that is the reason why that we are seeing more nuanced geopolitical promises coming from major candidates, although some of the elements are still there. Some of the traditional elements are still there. Lee Jae-myung is calling for the transfer of wartime operational control to South Korea, and that could mean a lot of changes in terms of the geopolitical setup on the Korean Peninsula. Sri?
Massive in tray, isn't it? A divided country, healing that divided country, and of course the external challenges that tariffs present, and balancing the relationship with the United States. Great coverage. Sherry, thank you very much indeed for that.
Yeah.
Turning to Southeast Asia, tensions are flaring again between Cambodia and Thailand over a long-standing border dispute. JB Ong brings us the latest. What's at the heart of this, JP?
Well, this latest skirmish, actually, between Thailand and Cambodia, if I can call it that, refers to the May 28 clash that happened ironically, a day after the ASEAN summit wrapped up and 2 days before the Shangri-La dialogue here in Singapore, where we saw a border clash between forces from both sides, and a Cambodian soldier apparently losing his life. This is in the area called Chongbok, actually, in the northeastern part of Cambodia, apparently where there are some areas where there are temples and that are actually being disputed, at least, as to who actually owns it. And it's just one of a handful of areas actually on the Thai-Cambodia border that are being disputed by both sides. Now, to be fair, Sri, the military chiefs and the defense chiefs of both countries have continued to hold talks, but the Cambodian Prime Minister said they are going to elevate this now to the International Court of Justice, actually, to make sure that they can at least establish the border demarcations to make sure that no future flare-ups actually happen. Now, Now, it's important to note two things, Sri. This is not the first time they've actually had flare-ups. In 2008, they had a similar flare-up with 20 people died. There were riots in Phnom Penh in 2003 because there was a Thai actress who was falsely reported to have claimed that Angkor Wat is theirs. This was a false report that resulted in these issues. So again, relations between the two countries are not rosy. But keep in mind, ASEAN is trying to develop a stronger regional economy, actually, and this will further complicate things because, again, there are some border disputes among countries within this area.
JP, excellent. Thank you very much indeed for that explanation. We're back in 2 minutes. Welcome back. Let's take a look at the Asian markets, and it is something of a split picture. We are seeing some strength in the TAIEX and the Shanghai Composite, despite some disappointment with the Caixin PMI number. However, Thailand is down quite heavily, off by about 1.3%. And we are counting down to the market open in India. Let's give you another glimpse of the futures picture. GIFT Nifty futures are pricing in an implied open in the region of about 24,840. So if that does materialise, then we're looking at about 100 points or so to the good. At the open, dollar-rupee exchange rate 85.5210. Now, IATA's annual general meeting wraps up today in New Delhi. Indian Prime Minister Narendra Modi made a keynote address yesterday, taking the opportunity to highlight the country's soaring aviation market. CNBC travel editor Monica Pistrelli has the full recap.
India is using IATA's 81st AGM to send a clear message to the world, and that is that the country's aviation growth story is no longer in the future, it's arrived. The importance of the two-day event in Delhi was underscored by the presence of Prime Minister Narendra Modi, who delivered a 15-minute speech which called today a takeoff point for a new India ahead.
Indian carriers have placed orders for more than 2,000 new aircraft, and this is just a start. India's aviation sector is standing at the takeoff point from where it has to fly long and high.
India's Minister of Civil Aviation highlighted the country's infrastructure accomplishments, which includes more than doubling the number of airports in a decade. Another 50 are set to be built in the next 5 years. This comes on the heels of IATA's revised annual outlook, which shows that tariffs and geopolitical problems in the first half of 2025 will limit growth this year. This after years-long shortages of jets and jet parts, a situation many CEOs have openly complained about. in the halls of the summit. IATA Director General Willie Walsh now says the problem may persist through 2030, which he called off the chart unacceptable. For CNBC in New Delhi, I'm Monica Petrelli.
Thank you for that, Monica. Now, Reuters is reporting that Air India is in talks for major new aircraft purchases from Airbus and Boeing. It could include around 200 more single-aisle planes as it continues its massive revamp, and would come on top of its nearly 600 plane purchase across Boeing and Airbus in the last 2 years. No comment from Air India, Airbus or Boeing. Air India has suffered, remember, from major underinvestment as a state carrier and is now on a path to modernise the fleet since going private. Turning to Marriott International now, which has announced a new brand for its mid-scale and upscale lodging segments, Series by Marriott. Marriott is making an equity investment in Indian hotel company CHPL, and both firms will be rolling out a series of properties across India. Let's talk more about how Marriott is positioning in the massive Indian market. And bring in Rajiv Menon now, President for Asia Pac, excluding Greater China at Marriott International. Rajiv, great to have you on Inside India.
Thank you,
we all know how incredibly diverse the Indian market is. So where are you targeting with this new brand and partnership? Is the focus on mid-tier, affordable, and what role are you playing in luxury?
So, Sri, as you look at the India market, for us at Marriott, it's always been one of the most strategic markets in the world. As India today stands for us, we have over 29,000 rooms operating with about 158 hotels and a pipeline of another 112 with some 20-odd thousand keys. That makes us the largest operator in India by the number of rooms. So today we are in 42 cities across the country. When you look at how India is transitioning to become the third largest economy in the world by 2030, middle class is going to get to over 700 million people. This is where the real opportunity sits. So our announcement, which is a global announcement of a soft brand or collection brand, Series by Marriott, with a founding deal in India with Concept Hospitality. Through this small equity investment, we are looking at bringing around 84 open hotels and a pipeline of about 31 hotels into our system initially, which is about 8,000 keys, and grow them exponentially over the next few years. Again, if you think about 42 cities today for us, by this time next year, we would be in some 90 cities across the country. So as India's economy grows, middle class grows, that's where the real opportunity is, in the secondary, tertiary, fourth tier cities across the country. Now, when you look at the luxury segment, on international brands, when you think about our competitors, we own almost 60% of the market share. So we are one of the largest luxury players in India already, with brands like Ritz-Carlton, St. Regis, JW Marriott, very well positioned. It was really about partnering with a very reputed regional brand like Fern and bringing them into our portfolio, which is a win-win for both sides. For us, it gives us deeper distribution across the country. For Fern, which is a regionally established, reputed brand, eco-friendly in focus, it gives them access to the power of Marriott with our global channels and the largest loyalty program, Marriott Bonvoy, with over 237 million members around the world.
And travel in hospitality is becoming increasingly experiential, so I'm sure you're targeting a younger demographic and Gen Z. But in the here and now, Rajiv, did the flare-up between India and Pakistan impact the business in any way?
When you look at first quarter for us in India, our RevPAR growth was 16%. So really, really strong. India has been one of the strongest market for us here in Asia Pacific. In May, we did see a 2-week blip where there were considerable cancellations. We did see airports being shut down, many of them around 32 around the country. But that has bounced back very strongly. So we believe as we look forward now to June and beyond, we would be looking back again at double-digit RevPAR growth in the future.
That's good to know. And you preempted my next question, Rajiv. Do you have a line of sight on what the upcoming peak summer demand season could deliver? And are advanced bookings telling us that this is going to be another knockout summer from an occupancy standpoint?
So in the first quarter, we already exceeded 76% occupancy in India, in our hotels. And when you think about the India growth story, it really is a domestic-driven growth story. And I expect with double-digit RevPAR growth coming back from June onwards, that we will see occupancies again in the mid-70s and good lift in average rates across the country. It really is, Sri, the secondary and tertiary markets that are driving growth as much as you're seeing Mumbai's and Delhi and Bangalore in particular performing strongly as well.
Is that a reflection? It's interesting you mentioned the secondary and the tertiary areas and cities. Is that a reflection of demand for visitors visiting maybe pilgrimage sites, religious oriented travel, trips to the countryside, those sort of experiences? Is that what's going on there? Is that what's driving it?
You're right. Religious tourism has really been on the rise, and we see that continuing. So when you think about today, Marriott has hotels up north in Katra near Vaishno Devi, in Nashik, in a number of other religious destinations like Amritsar, and these markets were doing very, very well because in the old days, as growing up, kids, we would go to these places, typically go and visit the temples and then return very quickly, just a one-day affair. Today, what we are seeing in most of these markets, people are going and staying there for 2 to 3 days, doing some social activity like celebrating birthdays or wedding anniversaries, and it's really on the rise. So also with what we saw coming out of COVID, people started to really explore their own backyard. And same is happening in India. As higher discretionary income is coming along, we are seeing people spend money in secondary and tertiary markets by traveling to urban resorts or 2 or 3 hour driving distance hotels around them.
And that mini ecosystem, I'm sure, is flourishing. A great colour there, Rajiv. How is sentiment and confidence amongst business travellers, and how is that translating into the MICE market for the Marriott, meetings, incentives, conferences and exhibitions?
So business travel was one of the first to bounce back in India coming out of COVID. While we saw in the rest of the world people were still working from home, India was one of those markets where we saw business travel come back strongly, and that has continued ever since. In fact, after the 2-week blip in May, we are seeing business travel back to pre-May numbers already, and I expect that will continue. MICE market has also been on the rise, as much as the big Indian weddings have been over the course of last few years. So next year, we will open our largest convention facility hotel in Delhi at AeroCity, which has a 4,000 square meter ballroom and close to 70,000 square feet of meeting space, a Marriott Marquis and a St. Regis hotel. And that tells you the confidence we have in India as a destination for meetings and incentives.
Sounds like a great party to me, or the venue for a great party. So you touched on AeroCity, and that's really interesting. And Monica's been doing some great work about this, and the GCC India Economic Corridor, and how that is very active and growing rapidly. And that's a testament to exactly what you were talking about, a rising middle class in the GCC region, in the India region. How is Marriott looking to capture that opportunity from the international market inbound?
Globally, Marriott has close to 240 million Marriott Bonvoy members. So we have deep membership base across every part of the world. And what we see today across Asia Pacific, which is in my world of Asia ex-China, that 74% of our occupancy is driven by our Marriott Bonvoy members in our hotels. That's how strong the program is. So when international travelers look at India, when they want to come and experience India, they want to stay with a trusted brand like Marriott. So we feel pretty confident that we'll be able to capture a lion's share of the business that's coming into India, be it through GCC, through Southeast Asia, or through US or European markets. Indian inbound story has been a little bit soft. It really has been around 11 million inbound travelers. And that will grow exponentially in times to come, given the amount of infrastructure, the investments that the country is making. When you look at Prime Minister Modi's commitment over the last few years, heavy infrastructure investments, airports. You heard about the new planes coming in. So with improving connectivity, not only to the primary gateway cities, but also these secondary, tertiary markets, I think international travel is set to boom into India.
Whenever I go to any premium hotel in India, whether it's for work or for pleasure, it can be the Marriott, it can be the Taj or the Leela, I'm always tremendously impressed by the level of service. Are you finding the right people and the right team, from wait staff, from porters, front of house, concierge, managers, to do the job? Or is there something of a talent competition or talent crunch?
Sri, there's definitely talent competition, right? So as a company, we've been in the business of hospitality for 98 years. Very, very strong values of taking great care of our people, so our people can take great care of our customers, and customers keep coming back. As a result, Marriott has a team of around 32,000 associates in the country and growing. Now, how we source these folks, which is predominantly through our partnerships with local schools, local universities, bring them into our system, spend considerable amount of time and resources in training these associates, and then growing their careers. What I have been extremely proud of is that we have not only grown Indian careers through our hotels in India, but today a lot of our talent that had grown through India are running hotels all over the world. So we've created a global supply of hoteliers per se, and that has given us this reputation of one of the best companies to work for. So as a result, we have been blessed to have an incredible talent pool.
In terms of efficiencies and productivity within the hospitality business, what role does integrating AI into operational efficiency at the Marriott within India play, and how does that work its way into the pricing environment? Can you give us a sense of the outlook for room rates, Rajiv? How challenging is the cost base right now, and where does this leave ultimately margins for the business?
India's biggest challenge always was the land cost. The cost of land, generally for any project internationally, should be around 15 to 20%. In India, it could have been as high as 50% at times. So as you looked at building hotels, high interest rates, high land cost, and loans would typically be given for 15 years. So it became difficult to very quickly be able to deliver return on investment. However, over the course of the years, as demand has come back, we've seen strong growth in room rates, overall revenues, and today, ROI on a hotel can be anything from 6 to 8 years, which is fantastic. So when you think about AI, Marriott is doing a lot of work on AI. It'll help us improve productivity. We already are using it in our reservations process. So, if you were to call our customer engagement centers and today it's all about experiences, as you mentioned earlier. So if you were looking for a resort with very specific requirements of your family, our agent could spend almost 7-8 minutes, first and foremost, researching and then selling the resort to you. Today, we are able to research within a matter of seconds and spend most of our time engaging with you in selling the experience. That's how AI is already making the difference. And I expect the productivity improvements are only going to continue in the future. In fact, Marriott is going to open our GCC in India in the next few months. We announced it, inaugurated it, and it's under construction. We expect it to be launched by October this year.
Brilliant. Rajiv, thank you for that. Just the final question is about taxation. From what I understand, customers could be facing or are facing upwards of 28% tax on some rooms, 7,500 rupee a night stays. Is that problematic? Does that need to come down? And is that stifling demand to a certain extent?
When you compare it to global standards, it's definitely on the higher side.
Yes.
And it does, create a little bit of a challenge.
Yes.
Now, in the past, our industry, and particularly the luxury hospitality space, was really looked at as an amenity for the rich and wealthy. Today, that perception is changing. It is one of the biggest employers in the country. Tourism contributes close to 7% to the GDP of the country. We expect India to get to about $475 billion in spending when it comes to hospitality by 2030. So today it's a real economic driver. And I think the government is slowly starting to come to terms with it. And we have been working closely with government authorities to improve a lot of bottlenecks. And I expect that they would continue to, look at our industry favorably and assist in improving these bottlenecks.
Rajiv, it's been a fascinating conversation. Thank you very much indeed for joining me on
so much,
Inside
Sri.
India.
Pleasure.
Our pleasure. Thank you. Rajiv Menon there from Marriott International. Now, staying in the travel space, global travel may be on the rise, but are airlines able to meet that demand? CNBC's Monica Petrelli got a chance to speak to the CEO of Air Canada about how the industry is coping with the ongoing shortage in jets. Take a listen.
We're absolutely being affected. We've got 90 planes on order, and many of them are delayed. Now, as you can appreciate, we put together business plans. We have a growth opportunity in front of us, and so it's frustrating when the OEMs are late in delivering planes that are critical to growth. So now it affects every airline out there. So it's kind of neutral across the board, but it's something that is concerning, and just not on the planes, also supply chain of parts as well. And so those have made our challenge a little more challenging to grow and to do better, basically, and satisfy that customer demand that exists out there.
And so, with deliveries, are you expecting any this year?
Yes, in 2025, but it's mostly narrow body. So we some 220s, Airbus 220s, which are great planes. We're getting some more MAX in this year, but starting next year, we'll get the Airbus 321 XLRs, which you can fly to Europe. Those are going to be exciting planes for our customers. And probably in 27, we'll start getting our Boeing 787-10s, which are the wide-body planes that will fly, that have great range, that will fly internationally as well.
Indian markets have been trading for a few minutes. We'll bring you some of the key movers when we return in 2. Welcome back. Indian markets have joined the trading day, and it's looking very flattish for the benchmark Nifty 50 at 24,660 or thereabouts. Let's give you the exchange rate, dollar rupee, 85.4470. And let's take a closer look at some of the movers in the Indian markets today. And check shares of Schloss Bangalore, 426.90. So down by 2%. This is after a fairly lackluster debut yesterday and after the Leela hotel owner saw a weak debut, as we said, on the Indian exchanges. Brookfield Asset Management owned Schloss, whose $409 million IPO was the second largest in India after Hexaware Technologies had targeted a valuation of about 1.7 billion. Shares of Yes Bank are in focus as the bank's board meets today to consider a fundraising proposal. There were recent reports suggesting that Sumitomo Mitsui Banking Corporation, which recently acquired a stake in the lender, is seeking approval from the Reserve Bank of India for a license to operate a wholly owned subsidiary. This move is seen as a step to gain control over Yes Bank majority ownership. However, Yes Bank clarified that it is not involved in any such talks. Excuse me. The stock down by 6.7%. We're also watching shares of Adani Group, the Indian conglomerate denying any deliberate engagement in sanctions evasion or trade related to Iranian liquefied petroleum gas. This comes after the Wall Street Journal reported that US prosecutors were looking into whether Adani companies brought Iranian LPG into India through their Mundra port. An Adani spokesperson called the report baseless and mischievous. And one final check on the Asian market, something of a split picture. We are seeing strength on the Hang Seng Index, although some weakness most pronounced in Southeast Asia, with the Thai set benchmark down by 1.3%. That's all the time that we have today on Inside India. Do keep watching CNBC. Dan Murphy's up next with Access Middle East.